Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending February 21st, 2025. So this week we are looking at the next decision of the Bank of Canada, which will be on March 12th. It's going to be a very interesting one because it falls on the same day as what is now only a threat, but still a serious threat that we could have an announcement on tariffs on aluminum and steel exactly on March 12th. Before that, there's a date where we will know if 25% on Canadian and Mexican imports also apply. So lots of volatility until then, or a potential for volatility. So maybe before we get into that, let's take a look at this week's markets at the close on Thursday. A negative week for bonds, mixed for stocks. Price of oil up 2.6% on the week. Price of gold still up by 2% on this week. So the geopolitical risk premium continues to get priced into gold. The USD was weaker on the week, so positive returns for the CAD and for the euro here at the end of the week. So a few topics here. Let's start with this week's tariff threats. Again, it's not me telling you that we should not take those seriously. We need to take them very seriously, but it's just that there's so many that it's hard to keep track of them. So here's the new feature of the weekly review. As long as we have new threats every single week. So this week it was 25% tariffs on autos. It should come. It's possible that it comes on April 2nd. Of course, the lobby of car producers in the U.S. is very vocal here. That the supply chain is just so deeply integrated in North America that it would hurt the U.S. consumer and U.S. firms. So let's see if it happens. Pharmaceuticals, chips as well are targeted, and more specific to Canada, 25% on lumber. Remember that lumber is already tariffed pretty heavily, above 20% tariffs on Canadian lumber already. So we could add to that. And of course, here's the lobby of the home builders, which is very vocal that you can do that because the costs of construction for new houses will just skyrocket. And so it's already reflected in the price because the performance of the home builder sector on the U.S. stock market is negative 20%, 20% since the beginning of December. So of course a very massive underperformance versus the market. Of course, because of the potential for higher costs, but also for slowing demand in the sector. So we'll talk about housing in a minute here. Before that, for Canada this week, we had inflation coming out. Core inflation is accelerating. Of course, it's important to look at core right now because of the GST rebate. We have, we exclude food and energy from core, and of course GST has a strong impact on food, especially food in restaurants. So 3.1%, that's an acceleration. It's noteworthy. Not saying that we are seeing a re-acceleration of inflation, but we are importing some inflation from the US right now. It's pretty obvious. And of course, the fall of the Canadian dollar also is inflationary for Canadians. Now, when you look at what the Bank of Canada will do next time, so it's on March 12th, market is pricing in 75% odds that it stays put. We think that this is fair. After that, there's April and June where we had the two next decisions. Now it's more of a coin toss for those two. We'll see how they package the decision. So we do expect the Bank of Canada to stay put on March 12th, so no hikes, but no cuts either. We expect them to use a language that focuses on inflation expectations. So they want to make sure that inflation expectations do not get de-anchored in Canada. So they'll be looking at surveys, they'll be looking at market expectations, and likely they will repeat the message that their job is to at first do no harm. Want to make sure that they have all of the information that they need to make the right decision. So likely it's going to be a very important decision in terms of communication and for the next steps. But likely the Fed, but the Bank of Canada will position itself into a risk management stance here. So this is what we expect from the next decision, which is 3 weeks away now. So talking about the U.S. Housing market now, on the left you have the mortgage rates in the U.S. So there's two lines here. The blue one is the 30-year mortgage rate fixed that is available in the U.S. right now, so close to 7%, so very pricey. But in the US, the usually households, they take 30-year fixed mortgages. So if you have signed before any rise in interest rates, then you don't really care, because you are locked in for 30-year fixed. So that brings us to the gray line on the bottom. This is the effective rate, so the average rate that is effective in the population. It's much lower than the 7%. So that explains why the US consumer remains resilient, even though interest rates have risen quite a bit, because the majority of homeowners that have a mortgage are signed for 30-year fixed, and they signed before those hikes in interest rates. But also, those that are the newcomers to the markets are people selling their homes and buying new ones because they're moving from one state to another, stuff like this. Well, now they're facing a very steep mortgage rate. So that leads us to the chart on the right. The demand for housing is falling fast here. Confidence is pretty low. Foot traffic is very low, and we're seeing on the right now that the delisting, so people putting their house for sale, there's not enough demand, pulling it off of the market. The delistings are starting to rise. Of course, there's some seasonality in this chart, but you're starting to see a significant move higher. So this is important because consumer confidence is impacted, of course, by the state of the housing market, and also big ticket items like houses, cars, furniture tend to move the dial on the macro picture. So if there's less demand for housing, less sales of houses, then there's less demand for furniture. And of course, it trickles down to a weaker economy. So again, no catastrophe yet, but an interesting development here in what seems like a very solid and mighty US consumer, starting to see some cracks appear through housing. So what we'll be watching next week, we'll have the CFIB Business Barometer, very important indicator of small business confidence in Canada. We'll have Q4 GDP growth data. After that, in the US, we'll have the Conference Board Consumer Confidence Index. The University of Michigan one tends to be a bit more narrow. The Conference Board one is broader. The narrow one, the University of Michigan one, showed a loss of confidence from households in the last month. Higher inflation expectations as well. Let's see what the more broad survey tells us. And core PC inflation should be pretty much in line with where the Fed wants it. So a bit above the long-term target, but still manageable. So shouldn't really change the stance of the Fed, which is clearly on the sidelines for the time being. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content of this review, please share, and of course, come back again next week.